Ben Robinson. A very interesting career. You have done professional yachting. You've mustered 600 head of cattle up in the Northern Territory. You were an accountant. You've lived all over the country too. It's very interesting. And sorry, to add to that, now a director of the Flint Group. Everyone's got their own version of Claude,
yes,
connected to each other.
And that is, our biggest superpower recently.
Your business operation, because this is the one side
minefield.
of the minefield. Oh, I think it's
I have a lot of fun.
It sounds like a lot of fun.
I've never to this day done an SMSF purchase above 80%, even though I can. It is not right in any setting with any lender for any residential property. Hands down.
You ever done the Sydney to Hobart?
Yeah, I think 5 times.
Well, there you go, okay.
Yeah, sail changes in the Bass Strait, 2 o'clock in the morning when you're on the end of the spinnaker pole, 2-3 metre swells.
Goodness me. I'm really excited that it's been exposed. Welcome to another episode of the Lazy Equity Podcast. Today we have got the ultimate definition of a top 1%er. Joining us today in the studio, we're going to go through a whole bunch of information around the mortgage broking side of the world in terms of the property landscape, as well as what it takes to really build an operation into what is, from my perspective, absolutely flawless and seamless. It's something that I've taken a lot on board with and I'm trying to implement into my business. And it's all by inspiration of our guest today, Ben Robinson. Ben, thank you so much for joining us, mate.
Thank you for having me, mate.
You've got a very interesting career and introduction into it, and I'm really looking forward to jumping into that with you today. And
we'll see where this takes us. Yeah.
Well, look, let's start off with, I guess, a high-level understanding. From what we know, obviously, we've been working together for a while now, and we love what you guys do. But your career, you've had many different avenues of a career, I would say. You have done professional yachting.
Yep.
You've mustered 600 head of cattle up in the Northern Territory. You were an accountant, which is very beneficial, I think, when you're going into the mortgage broking landscape to have both heads and knowledge under that operation, especially when you're buying property. And you've lived all over the country too. It's a very interesting little stint you've done here.
Yeah, so...
And sorry, to add to that, now a director of the Flint Group.
Yeah, so we started out, grew up in Newcastle, did school in Newcastle, did university in Newcastle, lived in Sydney for a period of time. That was cramming university schedule into 3 days so I could do the professional sailing, which helped funded through uni, set up a couple of sailing academies as well at a couple of yacht clubs.
Up in Newcastle?
Yeah, one in Newcastle. That was inspired by the operation at the CYC in Sydney. So we were coaching there. There was the director and the Commodore of Newcastle Yacht Club approached us. We'd known him for a period of time, myself and a good mate, Murray, who was also doing uni at the same time, same degree. So yeah, it was a really, really good time. We had similar sort of knowledge and sort of trajectory of where we wanted to take that yacht club, because it had a great foundation, and to build a yacht club, you do need your younger members coming through, and that's produced through youth sailing academies. So yeah, it was a very, very good time. I got my degree done. The last 12 months I worked in accounting while I was doing the degree from all avenues in Newcastle at the time. That was a really good employable skill set to have and a really good foundational sort of knowledge set as well. So that then leapfrogged me into brokerage with a stint in the Northern Territory between.
So, which is a very interesting idea and concept.
Yeah.
What was the reason behind that?
Well, you either do it when you leave school
and
you take a gap year, or you do it after university.
So you chose the Northern Territory over Europe, essentially.
Essentially, yeah. So during uni, I did take 2 second semesters off 2 years in a row.
Yeah.
To go to Northern Hemisphere, do a lot of sailing. That was awesome. So that was a lot of travel.
Whereabout was that?
So usually we'd go do uni exams in June, fly to Sweden. There was always a good regatta in Sweden.
Wow.
Then we'd go to the west coast of America. We had the Governor's Cup there. We'd then go East Coast America, a couple of regattas there, then do sort of Chicago, Detroit, then back to Europe. And then sort of come home back to Australia, New Zealand in around about October. That's when a lot of the yachting kicks off here, coming into summer. A lot of it based out of Sydney, a lot of it based out of WA.
Wow.
Yeah, it was a very fun time.
The obvious question, you've ever done the Sydney to Hobart?
Yeah, I think 5 times.
Well, there you go. Okay.
Yeah.
I mean, over them all, would you say, how does that sit on the challenging level?
It's a different sort of challenging. So growing up, you do all of the dinghy sailing, the high performing. You're on the water for 6 hours in the sun, but it is a bit of an endurance race, especially if you're on a smaller boat. I've fortunately only done it on boats bigger than 55 feet, so it takes a couple of days. But sail changes in the Bass Strait 2 o'clock in the morning when you're on the end of the spinnaker pole in 2-3 metre swells.
Goodness me!
It is eye opening. And you've got 15 to 17 people on the boat. So it's very much a team effort.
But these are the characteristics that really do contribute towards a high-performing person, whether you're in business or whether you're in sports. And if you're starting off in sports, you always see that flow on into business. And I think that's what impresses me so much about what you're doing at the Flint Group, and all the initiatives that you're putting in place with AI and technology that, it resonates with me very, very much so, as you know. And I can't wait to dive into that with you, and we'll get there in a sec. But how about that the stint in the Northern Territory, 600 head of cattle? What was that about? I mean, well, you're a country boy, we know that. Yeah,
and as I said, it's one of those once in a lifetime experiences. You can't do that when you've got young kids in the same footloose approach. So that was we did a big trip up to Northern WA, did the Gibb River Road. And I called a friend who did a stint up there working for a contractor straight after school. So that contractor went around to a lot of stations in WA and the Northern Territory. So I called him, he called in a few favours and placed me on a 2.5 million acre station in the middle of the Northern Territory.
Oh.
So we were running about 50 to 60,000 breeders. So working off, a 90 to 100% calving rate, you're dealing with over 100,000 animals.
What does that all mean to somebody who doesn't understand anything about farming or cattle?
So what it meant was it was owned by the company was CPC. At that time it was owned by Terra Firma, which is British private equity.
Okay.
Before that it was the Packer family. Okay. So big operation. Most of our cattle would go about 700 or 800 kilometres north to Darwin to graze on the floodplain to then go on a boat to Indonesia. So it was all export, all live export mainly.
Okay.
So
wow.
Huge proportions, huge scale, planes, 55-person full-time crew. It was pretty wild.
Yeah. Big management.
Big management.
I'm sure you're preferring your team this size.
Well, it's a bit easier. Everyone's behind a laptop and easily reachable.
Everyone's got their own version of Claude, connected to each other and their team. So.
And that is, our biggest superpower recently.
I know, and I think that's where we want to go with this chat and understand a little bit about those initiatives and those pathways that you've learned or that you've taught yourself to make the team as dynamic as what it is inside the Flint Group, and your, involvement and your excitement around this idea. You've got a really good team. We know them. We've worked with them quite a few times now. Run us through them, and I guess who's doing what inside the business.
Yeah, so at a surface level, the business is quite large, but it is very much potted per broker. So based on the level of loans written per broker, the team is proportionate. My team consists of 22 individuals. There's at the top level, there's broker and client manager that are also accredited brokers as well. So they do have product knowledge, they do have deal knowledge as well. Then we've got our level of credit analysts, so they help us with valuations, pricing, structuring the deal with guidance from us to really be able to put lending together that's current but also not going to prohibit us doing, building a portfolio in a sustainable and scalable method.
Yeah, and I actually want to ask...
So important.
Yeah, it is. So it's so important. And I think obviously your background of accounting and then your incredible knowledge around broking and the finance lending worlds, they are hand in hand with being able to really structure things properly.
Yep.
We know that when we work with the clients and they want to go and talk to their accountant before they go ahead with the purchase, we know what that's going to look like from a... not always, obviously, because there's a lot of accountants that are becoming way more astute now with bank lending, which is fantastic because I think the spotlight of investing has been opened up so much more over the last few years to match up with lending, or rather accounting and lending. And that difference there, I'm really excited that it's been exposed because I think that when you are trying to put my fingers in inverted commas, not show your income to the bank because you want to try and capitalize off or save your tax payments. but then you need those to be reflective to the bank so that you can get lending to support the purchase. It's that balance that really...
We explain that to clients a lot of, your accountant has an important part in the transaction, but you've got to balance your sort of expense minimisation with tax with your wealth building in asset. And, some years we might not acquire because maybe we bought 4 properties the year before. Maybe we are just going to have a year of consolidation and we can afford to be a bit more creative from a tax side of things. But the next year we're going to ramp things back up, and picking that up ahead of time, catching up with accountants in that sort of May, June, having a look at what those financials will look like, having a look at how they compare to previous years based off turnover profitability and where we're going to need to be to action those next acquisitions. It used to annoy me a lot of, you get clients come to you urgently wanting to fund something, and then you're either having to go and do some low doc lending, you're doing some higher interest lending, or you're having to go back and get accountants to rush tax returns, send them through in draft, modify them. It's a very manual process in a period where there's an acquisition. There's something there. It's the next PPR. It's the next investment. We've got something off market for a period of time, and we're not. Otherwise, it will go to market. So, being able to be ahead of that is nice. We can't do that all the time, but for a lot of our existing clients, they understand the ritual of us reaching out, copying the client in around that time period, the accountant having trust and pre-existing relationship there, they share them, and we're not trying to do any lending off this right now because we can't get tax returns done until July. But it's not running that reactive business model, because for a lot of the biggest opportunities lie in your complex income structures. And these could be PAYG, these could be self-employed, and all sophisticated investors have some form of SPV ownership, or that will be soon in the conversation.
Yeah, it is difficult. I mean, we were speaking earlier just before the show, how you've got a client at the moment who's been able to strike it, I wouldn't say lucky, but
He's a unicorn. He's a unicorn.
With 9 properties in the portfolio, all in personal name, all with incredible equity, with an LVR at 55%, I think you said. And able to go very aggressively, and on, I wouldn't say an aggressive income either. It sounds like it's a fairly balanced income.
It's a balanced income. He's done well. Like I said to you, he's a unicorn client because he doesn't have any ugly ducklings in the portfolio.
Yeah, you throw one in, and then you have to figure out a second tier.
Yeah.
Or you have to find out a remortgage.
Or he's bought a 1-bedroom apartment somewhere that doesn't make sense. 4 years ago, it hasn't grown in equity. He funded it at 90%. We see this from time to time, especially investors that buy something without a plan. That is my biggest bugbear.
Yeah.
You've even got young first-home buyers, first or second investors that are still buying stuff that's either too expensive for their trajectory of earnings.
Traps.
Honestly. You need to focus on capital growth properties earlier to create your deposits. You simply don't have that capital base, and we just can't be looking at, okay, we've got $400,000 to spend, let's go buy this. Let's try and create another avenue, guarantor loan. Do we wait 6 months? These properties are going up quite well. Do you have large discretionary income that you could save to accelerate that journey? Is a bonus going to drop? We've got a lot of guys that are in sales, investment banking. Their bonuses are enormous. They can come in. Yes, they're taxed at 50%, but that can move the needle.
Absolutely. And I think you mentioned something that you don't want to buy the wrong property. You do need that structure and that strategy at the right time for you as an investor at your lifeline of investing or timeline of investing. When you're looking at the timelines, what's your idea around sort of commercial properties and structuring them within different vehicles like SMSFs or whether it be companies or personals? Where and when for who and how?
Okay, so let's start with SMSF. So there's 2 main strategies that I think are quite robust. If you've got a low SMSF balance and you're a young accumulator, you go to residential property. We're not buying sub 100 square metre storage sheds in a suburb that's going to have another 1,000 built in the next 10 years. When you've got shorter leases, you've got tenants that aren't tied to fitting out the place, so they don't mind handing the keys back after 12 months. We need to go residential. We want to be sub 80% because, again, if we're over 80%, I've looked at so many proposals. I've never to this day done an SMSF purchase above 80%, even though I can. Okay? I can earn the commission on that. It is not right in any setting with any lender for any residential property, hands down.
On what basis alone?
On what basis? Inside of super, you've got no negative gearing benefit.
Yep.
Your super fund is designed as your retirement. It's designed to grow.
Yeah.
If you're putting a residential property in there at 80%, almost everywhere in Australia, you're not buying that cash positive. You're buying it to a low, it might be slightly cash negative, but we're looking at that capital growth profile. That's the biggest way of we're trying to grow our fund balance. We might do 1 or 2 property cycles, then turn it on. We might redeploy that money into shares. This is sort of where the financial advisor comes in as well, especially if you're not using all of your money in super. So that's the sort of residential side. For guys and girls that are younger, that have a smaller super balance that might be sub, say, 250, where it's not really moving the needle to get us into commercial, but we're trying to grow the fund balance. And we're not trying to hold on to that property for passive income long term. We're using it to turn it on in the future, to recapitalise the fund, to then have options to redeploy. The second part of that is commercial. Most commercial properties, and again, this is quite general and I'm not a buyer's agent, but we see a lot of commercial transactions. And a lot of the commercial transactions today that are good value are between sort of 1.3 and about 2.5. Again, we don't want huge assets in super. We don't want to get to that unrealised capital gains tax threshold too quickly before preservation age, because we can't do anything. We just pay double the tax. The goal for that asset is to fund at 70 or 80%, given the fund balance. We get, an interest rate proportionate to fund balance. But if we're targeting commercial property between that 1.3 to 2.5, that's at a 6% net yield, so a double net lease, so the tenant's covering the rent, the GST and the outgoings, and we fund that at a 7.5% interest rate, that is cash positive.
Yep, perfect.
So perfect. So your contributions either from your business or your employer are going in, they're still growing that fund balance, and that property is paying itself off principal and interest, contributing a small amount to the fund, which is fine.
Perfect.
Fine for young accumulators.
Yep.
We don't want to pay too much cash into that acquisition. At the moment, this might change in the future, we can refinance properties in SMSF, but we cannot release equity.
Nope.
In the future, if we want to make a lump sum contribution to clear debt, that's fine, because we've spoken to our accountant, we've spoken to our financial planner, and we've had a conversation, and at no cost, the client puts money on the loan, they knock off the loan limit, it reduces repayments, it contributes more to the fund net of rent. They're the main 2 strategies.
Yeah, absolutely. I couldn't agree with you anymore. I mean, I think the biggest misconception around getting an SMSF purchase into a portfolio at the moment is potentially just not the clarity of when you should do it.
Yep.
And I think, obviously, this is not financial advice because we are not financial advisors, but if you have the ability and if your fund holds it, get into it as quick as you can, depending on what your budget is inside the fund or the trust. Do it. Because the longer you have that property inside a market, which is capitalizing at the market's rate versus what SMSF is doing, or just normal super rather, it's really just, it's a no-brainer. You're capitalizing off the leveraged value at a more aggressive rate of return, what the fund will ever be able to produce on its own. And so get it into property as quick as you can, really.
As quick as you can. I would say as a rough guide, you need around 200,000.
Yep.
In super.
That was my next question. For both those scenarios, why don't you give us a budget for each?
Yeah, so if we have around 250 in super and we roll it into an SMSF, 200 to 250 is really the baseline, because we want to have options. We don't, if we've got 150, our purchase price is probably sub 600. Different lenders will have different requirements. 20% plus costs, plus we need a liquidity buffer of 3 months worth of repayments. Some are more than that, some are less than that.
Yeah, and so sometimes it's a little bit easier to put in a 30% if you can, so that you don't have that holding cost.
Yeah, and again, rightly so. Depending on the rental yield, it might mean that we're using 30%, but we've still got enough to diversify the fund. It makes sense. It might mean it's neutral, so your contributions are still adding to the fund to then reinvest elsewhere. But typically, as a guide, we usually try and target 70 to 80%, no less, no more, knowing that we can always clear debt in the future. Because again, we're trying to be productive with the super. For the client that came to us a couple of days ago, looking at a $2.5 million commercial with 800 in super, our advice is 70 or 80. We're going to do a proposal for each, show the rate difference, make a call based off that. Perfect. We'll probably do his pre-approval at 80, and then we tweak it based on the actual property he ends up buying.
Safer option.
Yep.
Yeah. And then, so that's the 250K. And then the next bracket.
Then the next is about 100 grand more.
Yeah.
So if you're around that sort of 300 to 350, that's really your entry level commercial. 350 and higher is more preferred, especially if we're trying to sit in eastern markets, metro locations or large regional settings, because we want square meterage. We want square meterage. That's the goal of the investment, not looking at sub-asset classes in commercial. Between retail, industrial, we just want to have a budget so we've got options, because the volume of commercial property traded each year is far less than residential.
Yeah.
So we want to be able to jump at something and not be just looking at that low end, which a lot of investors are trying to target.
Yeah. And also, if you are a younger investor, you probably don't want to put that money into commercial yet.
Yeah.
You'd probably want to put it into a resi so that you can bolster that.
Well, again, we've had a couple of clients recently that are in their 30s.
Yep.
They've got really good fund balances because of high-paying roles. And, we've gone and done 2 resis. 2 high-growth resis.
I guess that's the catalyst there, I guess. Hey?
Yep. Yeah. It's all based on fund balance. So I don't mind doing 2 resis. Both loans go in the SMSF. We have 2 separate bear trusts set up. Again, to recycle and pivot into something else later. And it could be back to shares. I'm not averse to shares in any way. We contribute to our managed fund each week. Like, we are diversified. We're not just property, but property as a young investor has such a big part of it. Yeah. Especially with the negative gearing, especially the ability to control an asset that's worth $800, $1 million, $750, with an investment of say $100,000 to $200,000 of equity. Especially if you're a lawyer, especially if you're a medico, there's lending niches. Yep. You're using a smaller amount to control a higher value asset that is growing at on a 10-year average of say 7.5%, which is quite similar to ETFs.
Yeah,
we're controlling a high value asset. It's simple as that.
Perfect. Love it. Let's move on to your business operation, because this is the one side
the minefield.
The minefield. Oh, I think it's
I have a lot of fun.
It sounds like a lot of fun. I think you've built something that's really inspirational for not just the brokering landscape, but everybody that really wants to get into, dare I say it, putting in a Lassian spanner in their business.
Yep.
Wouldn't say, I'm not promoting to let go of any staff or anything, but more so around making it more dynamic and taking the tools of AI and implementing them into your company and around your teams to make what was a churn of, potentially a 50% success churn rate to 150% because you've got these mechanics inside the business. Tell us a little bit about the tricks that you've put in place around AI and
yeah, so there's a few levels to it, and I think it is relative to the business you're running as well. So we deal with a lot of complex clients. It's either complex on the income side, as they're business owners, they've got multiple income streams, or it's complex on the acquisition or portfolio side, or both, and a lot of them are both. But handing that across to the team and running a team, so there's multiple points of contact throughout the deal. You're not, the only one with key man risk associated to you, where you've got family commitments, you've got health, all sorts of things. So the first one is Plord. Plord records not my calls, but my debriefs. So there are notes that we take when we're on the phone with the client during the strategy call, after the strategy call, but handing that back to the team can be difficult or take a long time. So previously we were emailing, or I used the dictation function on my laptop, which is...
For Plord or for...
Well, not for Plord, but before this. Yeah. And it's okay, but it's, Siri's not the best.
No.
There's gaps.
For those of you who don't know what Plord is, it's a little card or a necklace you can choose, or a bracelet, I think it is as well.
I don't actually have it here today. It's sitting
in mine on my wallet over there.
In my car, but it attaches to the back of the phone. It can record calls. I don't use that. I don't see value in that.
I don't use it for the calls either. I'm the same as you. I use it
just
for
handovers.
Yep.
Just handovers. And for me, where I've just presented a complex lending strategy that might be 5 to 6 properties, where there's all sorts of little bits, stuff's moving on different timelines, I can hand that back to the team and they can listen to the 3-minute voice recording, gives them the transcript, but it also gives them the AI summary with action points. So a lot of them read that summary while they're listening to it, and you can be a human, you can emphasize, they can hear your voice, but it's done in a way that creates a link that's in our CRM, so it's always there. I can do it on the fly if I'm running through the city or doing something like that, to WhatsApp, to chat, because we use Google internally. And it's a very, very dynamic way of handing stuff across. You can have a super complex call on the fly with an investor or a business owner and immediately get off that call, record, send it to the team, and it's all native in our system. So it's been a very good way for us, given that we've got a lot of complex clients, to do that handoff and be able to hit off on all points we need to, with tweaks in structure, with just the nuance in client strategy on the business side, the acquisition side, what needs to happen next. It's been really good.
It is. They're really good. I actually saw your post that you bought one the other day, or not so long ago. But
I've had probably 10 people message me saying they've all bought them and they love them.
They're brilliant. I've got mine hooked up to my G Drive, and because it's in the G Drive, I also connect straight into Notebook LM.
Yep.
And then you tell Notebook LM to create the podcast, and you can listen to the podcast version of whatever your meeting was. Benefit there is that it actually goes into searching what you're talking about. So if you reference anything in your meeting,
I need to do this.
You do need to do this, because this changes your perception of the meeting that you've actually had, and it brings in outside information, stuff that's on the internet that would support the arguments or support the facts that you're actually talking about.
Wow.
Yeah, it's a lot more powerful.
Yeah, and that's the journey of AI is a rapid one. I think that I've got a lot of good individuals around me that we constantly share stuff, and this is on social media, stuff to research further. And that's always the catalyst for this. So, this year, if we just look at Anthropic as a business, gosh, they've been doing this for a long time, but they've made it more accessible. Claude Code is not a new thing, but they've made it more accessible for you to be able to build agents, be able to use Dispatch on your phone to get tasks running on your computer. So you're getting off a phone call, and instead of putting that as a note in Notion or doing something like that, or me handing it to my EA or something like that, there's stuff that you can do that's high touch, that can have emails drafted for you to hit send on, either on your phone or your laptop, straight after the conversation. So everything can happen at a more rapid rate, which is good for deal flow, but also client success, client experience. Like it's an all-encompassing, and that's probably the next thing we'll talk about, Claude.
Yeah, well, I mean, I think the whole race and pace of everything these days is, if you're not on the front foot, you really are going to be left behind, and you have to be aggressively in front these days, because the race of business is just become so much more demanding from a client perspective. I've sent this to you. Where is it? Well, I just sent it. Yeah, but it should be ready, because it's AI. Everything is in an AI landscape at the moment. And what we're working on at the moment, and
it's very exciting.
It's very exciting. And hopefully this is a tool that we're going to be able to bring to the mortgage broking world that really helps you guys with your clients. That's for another episode, but we'll get
we can unpack that further.
But it really is something that, obviously we've got our software engineers inside the business here, because we're heavily invested in tech and building. Christo and Tony, just behind the curtain over here, they are incredible developers, and their speed of execution, because of Claude, for example, is just phenomenal. What we used to do versus what we do now is mind-boggling. I can't keep up with what they're doing, and you're doing it on your own as well, and you're doing it from a self-taught perspective.
Well, yeah, so we've got a few big things going on in the background that I can't say too much on, but some of the key chats we've had recently is just around the changes in AI, and you can't spend 6 to 12 months building something because it's irrelevant in 3 months.
Totally.
So the pace that you need to do things that's accelerated by AI in helping build these products, in helping build these solutions, needs to be somewhat reinvented every 3 months, or have a basis that it can do updates that are, again, pushed by humans, that are, from a governance perspective, especially with all the data that we control, are controlled by humans. They've got the framework around them, but from a productivity side, they will go rebuild themselves, make themselves more efficient. Even 2 days ago, I got Claude Code to go through all of my agents and be able to develop skills to shorten the prompts, to shorten the runtime, to be more efficient on the use of tokens. And we had about a 40% uptick in efficiency of token use. So this is not going to mean a lot to a lot of people, but it just means that our agents are working quicker. They're working on schedules that we've set, doing tasks that we've mapped out for it, that used to take our team quite a long time to do. when they could be doing other high value activities.
Yeah, and you made it more cost effective by adjusting your token rate, which is kind of the same idea of employing in Sydney versus employing in Nepal.
Yeah.
Which we'll get to in a second. But it's really interesting that you mentioned this, because the reason why I was late this morning, I was at Kinzo. I don't know if you know, but I'm one of the founding members with Kinzo. And we were doing the product demo this morning with Frank. And in that product demo, it's basically it's the first release round to the founding members is this week. One of the questions that one of the other members asked was, what's the timeline and release of your product evolution? And Frank said, there is none. Whatever we say to you today will be absolutely changed in 3 months' time.
Yep.
And it just resonates exactly with what you said, that the rate of development in AI integration is far too rapid. Yeah. And it's a really interesting chat that we had then. Frank is a very inspiring guy, and he speaks a mile a minute because he just can't keep up with his thoughts. He's constantly thinking 20 steps ahead. Now, I don't even think that his own perception of where things will be in a month is going to be accurate.
It has to change.
Yeah.
It has to change. It's you can spend too long spending a lot of money building solutions that become irrelevant because they're either on platforms or servers that are no longer fit for purpose. And that's a big thing that we're working through at the moment, that constant development. It's the Claude Dispatch has only been around for maybe 4 or 6 weeks. It's not a long time. The Claude Co-work stuff has only been the start of this year. And then all of the other businesses that, provide services that we use, like Middle is our client portal. They were looking at creating webhooks for Claude. We can just create a secure Chrome connection to access Middle. So it's like those solutions are fast becoming extinct. Webhooks were something we were dealing with 2 years ago, getting stuff into HubSpot, which is our CRM. Yeah. So just the pace.
But even the webhook side of things, I think there's a recent article, I can't remember where I read it, or even if I heard it somewhere, but there's a discussion about webhooks becoming a real estate and somebody trying to commoditize them as a distribution channel, because they are obviously a distribution method, but soon enough they will become a resource inside a hub that people can tap into a lot easier, but potentially underneath like a real estate level where you're renting them out and you're buying them out. I'm sort of dancing around the topic here because I don't have all my facts in line, but it's just the fact more that I'm talking about webhooks now becoming something else other than what we know them as.
Commoditized.
Which is literally just a thing to take information, pass it from one area to another area, but it's going to be commoditized. And that's kind of the narrative around the changing of things,
Well, a lot of these AI platforms, and Claude's a perfect example, there's a list of integrations they've got as coming. So they're wanting direct integrations for all of these CRMs that might be HubSpot, might be Salesforce, all of these big providers where they see value in doing that and being able to offer that. Because, Claude is a product, but there's also a subscription for it as well, to be able to have the limits of recordings and be able to set up templates and all that sort of stuff. Yeah. So, with the Claude side of things, I guess where that has fitted into our business more recently, it's like, I started using Claude properly in the business at the start of the year. And that was because it became...
You ramped up quickly then, mate.
Well, it became more relevant. Before, everyone uses ChatGPT or Claude as a chatbot to answer questions. How long do I fry eggs for? Like low-level stuff, which is fine, but our use case is slightly different. We're wanting to be able to have a client that's settled for 3 months, that has 6 investment properties, to be able to get Claude to go back to Core Logic to have a look at valuation results, for it to go to our backbook of lending system to look at live loan balances. For a lot of investors, they're interest only, so it doesn't change much, if at all, but some are P&I. So again, just ticking that box. Being able to then format the data, set up a new deal in HubSpot, pull all the information out of those 6 deals that are in HubSpot. So we've got one relevant source that we can then have an email drafted to the client, the email sent out, it's showing the usable equity per property with a booking link for us. Claude's not sending those emails, we're sending them, but it's doing the legwork that's taken, say, 2 or 3 of my team members 2 days to put together in the past, based on getting pulled between different business duties. So it's far more efficient. So then my staff can do higher value activities of once that call has been done, that my team can go and request updated financials if we need to look at the income side of things, updated pay slips, and already have all of that relevant information sitting there at the forefront for them to deliver a strategy quicker, for me to present it quicker.
Going back to speed to market, this is what it's all become
That's all
about.
it is.
And when you've got so many clients like you guys are wrapping them up month on month on month, as we've got more than 1,100 clients in the business, and they have multiple purchases as well. So we've kind of implemented the same thing, but we're doing it through a WhatsApp process, and similarly through Claude. But we have our market valuation systems in place in our company, and it is important because you need to keep those clients up to date. You should never have a client coming to you to ask you what their portfolio looks like. You should be telling them, because that's really what's going to keep you front of mind in their mindset.
Yeah, and it's also doing the right thing by the client. So previously, and this is previously for years, we're talking 7+ years, it's your strategy call, you get your acquisitions done, your refinances, the client settles. We then do a call to the client to talk through, manual stuff like banking setup, making sure they're across everything, but also setting the sights forward. Previously we spoke about this is our next step, this is our touch points. Every client that settles, they've got a plan. They know what the next action item is. But a lot of it, for a lot of our investors with, say, sub 5 properties, it's always equity driven. When can we recycle that next deposit out? What can we do? So we would have a task set for, say, 3 months, 6 months. Still, it's something that we could do at 2 if this agent's running. We could do it we could recognise the opportunity at 4 months when we had a check-in at 6 months.
And you're setting up the triggers to be able to adjust to that. Yeah.
And we're setting up those triggers. So again, it's not to push the clients into property, it's showing them options. Yeah. Some clients will go, we want to buy 2 this year, we do the 2 this year, we want to buy 2 in 3 years. That's fine. But if we send them an email showing them their equity, they might sit on it for 2 months.
Yeah.
But then they come back to you going, we've just found, we've had this change and we'd like to do this because of that knowledge you've given them.
Yeah.
In a very, very sort of value-add, educational sort of way. And also for a lot of investors, you card a lot of property, you card a lot of debt. You're not getting that validation of big amount in the bank account. You don't really know the property's growing. You sort of do, but you don't really know by how much. But, even just those updates on net wealth, it helps keep property investors engaged in that bigger picture.
It's kind of that whole landscape of, we're talking about being first to market and quick to action inside the business because the client expects it. But also what you're saying there is that they don't really know always what their decisions that they've made to buy an asset is actually doing for their portfolio.
Yep.
But providing that back to them is a kind of that surprise service. And I think that's really important and really well done.
Perfect example of that was a client who was a first home buyer of mine maybe like 5 years ago. A while ago, property investment was never on their radar. Never on their radar. We did a review about 2 years ago and pitched the idea of going, you're sitting on this equity, this is what we could do in an educational perspective where we've done a proposal, no strings attached. This is what we could do using your equity, using your income profile to buy your first investment. They bought that. You bought that. The client, 12 months after that acquisition, that property has added 150 grand of value or something like a really, really good amount, as well as their existing property. We've then done another strategy because we spent the time educating the client on how this fits in. They've made the call going, this is right for us. They've then sought advice to buy the property. The property's done well. We've then used the equity in both properties to go buy the next one. So that next strategy call was like 4 minutes because we've spent the time at each stage educating the client to be able to make their own decisions using, what they've got. So that is so powerful. And we do that with every single client. We want them making the decisions backed by data that comes from us and having the right conversations along the way. And usually the best case is the client comes in, provides information, we do a strategy. If we need the next level of advice, that's when we go to the accountant. We do an email to whoever their accountant is, copying them in, going, we spoke about this is our plan. So then it guides the conversation with the accountant. If they need to set up an SPV, if they need to be involved, if we need to get tax returns done in a certain way, then it goes to buyer's agent. It's so important that brief is set for the buyer's agent because they don't have an idea on feasibility, nor do accountants. We aren't legally allowed to advise on tax structure. So it's like we've all got our parts in the transaction, and the best way to do that is going to the accountant with feasibility backed. So the accountant's not recommending structures they don't know feasibility on. And then the buyer's agent's got a clear brief of this is the property owner, because it could be 70% one, 30% the other. It could be 100% trust. It could be, a unit trust. Like there's all sorts of different structures. So then it's very, very clear on what we're doing. This is the price brief. We don't know where, that's your job. But this is the price brief. This is the yield that we're using from a servicing model. If servicing's tight, this is the ownership, and it's a handover of trust from one professional to the other. And
that is so important to get right in a quick and dynamic format, because the markets that we're shopping in are doing at the moment 2.5%, some of them, a month. And you miss out a month, and you've missed out on a lot of equity. Depending obviously on the price point.
It's all opportunity cost, isn't it?
100%. Like whatever you can do today, you probably can't do in 3 or 4 months' time. And that's the reality. So quickest to market wins. On that, you've obviously also got so the AI is a very big power and driver for you guys to get automations and your systems and your processes done efficiently. But you've also got your offshore team.
Yes.
Now, we've heard a lot of, and we've also got some offshore support in our business, but it typically goes towards the Philippines or Vietnam or India. But you guys have actually got a different angle on this.
Yeah, so we're in Nepal, and that's coming off the back of being in the Philippines for many years.
Right.
So in previous businesses, even our business, we pivoted fully out of the Philippines start of last year. So we had a foot in each camp because we were testing and measuring, and the Philippines have been great, but I feel like outsourcing has been there for quite a period of time. A lot of those established businesses provide staff. They take a big clip. Your staff are not getting a lot of money relative to how much you're getting charged. They're all always chasing more money. So that was a bit of a tough dynamic. That still exists, but we were testing Nepal. So we had staff hired directly in Nepal. So we were saving on cost. The aptitude of those Nepalese staff has been absolutely incredible. They've got a young, highly skilled workforce, and finance jobs in Nepal are some of the best paying and most affluent jobs over there culturally. So once we understood this fit, we lent hard into Nepal. So we've got our own office over there. We've got our own levels of management over there, head of compliance, head of credit. We've got our managing director over there who was over this week in Australia. She's been over a number of times. So being able to set up a business that has levels of management, levels of quality assurance that doesn't need to be handled immediately onshore is pretty powerful, but it does take some time. Yeah. So we also have a Flint Academy over there that brings in accountants, financial planners, intellectual people that have, got prior related knowledge and being able to apply that to loan writing to bring in our next wave of credit assessors and credit analysts. So it's very much really good for the Nepalese because we're providing job opportunities to, locally over there. And over there, we've become quite a well-known business from the way we treat staff. We provide benefits. We provide, accessibility to sort of healthcare, fitness and lifestyle initiatives. So it's very, very important to have that business set up as if we would set up the business here. So the engagement from the team is beyond amazing. Like it's hard to describe how powerful it is having them that know policy so well, that have the time to do that as it's their job, that complements your strategy, and have the knowledge base that we can hand stuff to them. They understand how Australian tax law works. They understand how businesses in Australia operate. They've got that deep level of knowledge. The average level of experience for all of our credit team is like 6 years. So, it's more than a lot of young brokers in Australia.
Yeah, amazing.
The depth of knowledge, it's phenomenal.
It's so good to have them so across compliance though as well, because that's
important.
Probably
it's
one
defensive.
of the hardest parts of going offshore is getting that understanding of compliance across.
Yep. Data security, it's a big one. We've got full-time security at the office, A for their welfare, B for data security as well. All of the laptops are managed by Australian IT. So there are all of these levels from a defensive aspect, given that we hold a lot of information. But, it needs to be secure at every angle, it needs to be efficient at every angle, and it needs to be value added at every angle. So for every client that comes through, having an offshore credit analyst in Nepal. They're phenomenal. They can communicate with clients exceptionally well. High net worth on the phone call. It is unbelievable. They love these guys. So it's always myself as a broker. It's one of our onshore client managers that are also broker accredited. Then it's a credit analyst. So you've got a dynamic team that if I'm, engaged for an hour doing this sort of stuff, that they've got those 2 points of contact where the client can call, the client can email, emails that come through get answered technically. So it is also setting up, the robustness of our business.
Yeah. So, I mean, you're obviously paying as much attention to the team there as what you are in your systems
Very
and
much
processes
so.
here, and probably more so because you have to be secure with all of that, that trust and the knowledge of what's being handled over on that side of the world.
Yep.
It's a different time zone, it's a different communication method. And I think that's, I might have to have a chat with you to figure out that side.
It's very, very good. Yeah, and it's, we're talking about a small country. We're not talking about India.
Yep.
We're not talking about the concentration of outsource staff in the Philippines either. So, that's why we set up the Flint Academy, is we need to bring people out of industry into industry and train them well, support them well, and show them the career progression. And it's very, very, I'm very proud that we can show them the career progression. We can have our data entry or loan processors graduate to credit analysts, because it's such a prestigious and affluent position over there and highly regarded, which is awesome. So we've got that career progression. We've got our heads of credit. We've got our team leaders. So at whatever angle they want to go within the business, we can support them, which again helps with staff retention, but it also helps from an engagement side of things as well.
That's awesome. I mean, you guys are moving at a pace that is admirable to many and most. I think you guys have got such a bright future at Flint Group. I can't wait to see what happens in the future. Actually, give us a little bit of a highlight. What's on the cards for anything coming up? You guys were just at the Carlisle. So you guys had what was that about?
Yes, that was what we call it Flint Ignite. It's something that we do quarterly. It's a full sort of national Australia team event. It's just about bringing people together. Nice. It's about aligning with the vision that we've got, what we're working on, what all of the various teams in the business are working on to collectively push the business and the brand forward. It's also a really good time just to catch up with people interstate. There's a lot of high performers in the business. Everyone can learn a lot from those people around them. And it's nice to just not be always on a phone call or a Teams meeting and actually connect properly.
I think that's something that you guys do so well at Flint Group, is connecting properly. I mean, the amount of events and social gatherings you guys have, and it always feels like you're almost missing out. It's not a forced feeling. It's you want to be there, and that's what your community, I want to call it, because I don't feel
Very
like it's a company. I think it's more of a community.
Very much so.
Really represents that so well.
And we've got a lot of really good people in the business. I think that's the big one. Yeah. That the way that we're building out our various offices is having people in those locations with local knowledge that know local talent, know what they want. Every office has got a different dynamic, but a complementary dynamic. And so it's about bringing those high performers into the business that align with the values, that align with the trajectory, and that are also really good people. Humble people. We don't want flashy. We just want some good people that are good at what they do.
Love that.
That can add value to themselves and those around them.
Magic, mate. Well, I mean, I'm watching from not afar. I feel like it's
you
fairly
got
close,
a front seat.
But I've got a front seat. I love it, and I'm loving the front seat. I think I'm really excited to see what happens with you guys and the partnership that we've got. I thank you so much for letting us be a part of what you guys represent, and I think we've got a really good future together. And just thanks so much for joining us today. And I think we're going to be doing this a little bit more often. Every quarter or so, we thought we'd do a little bit of an update on the state of play.
Yeah, I think it's worthwhile. The lending landscape has changed a lot, and if that's my final word, the banks are tightening up at the moment. Rates are going up. Pre-approvals for those that are tight on borrowing limits are changing. It's a dynamic landscape, and the onus put on DTI and trust lending over the last 6 months. Banks have fallen out of the space for various reasons. Yeah, it's something that isn't static, and you need to be careful. You don't want to be on a pre-approval without a broker that's supporting that you can't, that is forthcoming to you of going, limits have changed, this has changed, updating parties, because you can end up in an unconditional contract with an unfundable scenario. So it's very, very important, and something that, it scares the living daylights out of me of some of the clients that we get coming through that the broker couldn't get it done or went to the bank and they didn't explain the pre-approval, and now we're in a position where, fortunately, we always find funding solutions, but sometimes they're not cost effective. They're not where the client should have been through incorrect planning. It's a bugbear of mine. Boils my blood.
I think you used the word dynamic there, and everything that we're doing and existing in at the moment in the world is being dynamically updated.
Everything's changing.
And so that all affects and runs down to what we do, down to getting your loan right, because there's worldly impacts that change sentiment, as well as legislation. And I think because everything is so dynamic these days, let's keep up to date with things, and we'll meet up every few months and give a bit of a state of play and basically do what we've just done today, but a little bit more of a state of play version.
Yep.
Well, mate, thank you so much for joining us today on the Lazy Equity Podcast. I'm really looking forward to the next time that we catch up again and give them some more value around what's going on. I think the next update will be more relevant to particular scenarios in terms of lending, borrowing, buying, where, how, why, and what, and all the strategies involved with all of that. Thanks very much for joining us, mate.
Thank you, mate. Appreciate it.
Until next time on the Lazy Equity Podcast, we look forward to chatting with you guys soon again. Then, if you have any questions, please pop them through to our socials. We love talking about them on the pod. But until then, keep well and chat soon.